Hey there, everybody. This is Scott Bauer, CEO of Prosper Trading Academy. And for those of you that are, stock traders, that's kind of your go-to, that's your sweet spot. I want to introduce you to the world of options and why options offer you so much leverage. I'm not trying to take you away from trading stocks, but what I'm trying to do is potentially enhance your ability to make money. And again, options do offer so much more leverage, so much more bang for your buck than trading stocks. So let me bring you into the world of options here with a little bit of an introduction and show you why that can be so valuable. So as we're looking on the screen here, we're looking at Apple, okay? And the current stock price of Apple, as you see, is basically $142. Okay, so if you wanted to buy 100 shares of Apple, okay, what would that cost you? That's going to cost you $14,200 to control 100 shares of Apple. Okay, and what do you have there? Well, your risk is unlimited down to zero, right? You have $14,000 of risk. You definitely have unlimited upside also. I mean, Apple can go to infinity, right? And you just hold on to your stock and you make money, but you do have that risk down to zero. Now, one of the beauties about using options and trading options is that every option contract gives you the right to control 100 shares of stock. One option contract gives you the right to control 100 shares of stock. So let's take a look here. Let's take a look at the what's called the option chain for December 16th options in Apple. So what you're going to see here is right in the middle here, all of these numbers. And they say Apple and then December 16th, and then they have a number next to it. The December 16th means that is when those options come to an end. Okay, options, unlike stock, have a finite lifespan. It could be a day, a week, a month, 6 months, 3 years, okay, where options are out there. Whereas stock, you basically hold till whenever you sell it. Okay, there's no timeline on it. So every option has what's known as an expiration date, where that option is either at expiration date worthless, it goes away, it's not worth anything, or it converts into a stock position. So going back to our example here of, whether you wanted to buy 100 shares of Apple at 142, it's going to cost you $14,200. Instead, using options, I could buy the 140, which I'm circling right here, a 140 strike. That's what is known as the stock price that you could potentially turn your option into. It's known as the strike price or the exercise price. I can buy that 140 call option, and we're going to go into the two different types of options there are, calls and puts, but the 140 call option, you can see right here, costs me $4.70. Okay, hopefully you see that right there. Now, what does that $4.70 mean? We've got to look at an apples to apples comparison here. Okay, so I can buy the December 16th expiration 140 strike call option for a price of $4.70. Okay, now remember, every single option gives you the right to control 100 shares of stock. So when we're looking at option prices, what we have to do is look at the price of this option, which is $4.70, and actually multiply that by 100. So the notional value or the notional cost, my investment cost to control 100 shares of Apple is actually $470. Okay, so my real cost to control 100 shares of Apple is $470. Okay, and this allows me at any time between whatever date you buy that option and the expiration date to basically turn your option into your brokerage firm, literally, hand it over to them, and they'll give you stock back at the strike price or the exercise price. Okay, so for a $470 investment, I can own Apple stock at 140. Okay, now it's not 142 like if I was buying 100 shares of stock. The actual cost to this, or my break even, okay, would be 140, where I can buy the stock. That's what this option gives me the right to do, plus my investment of 470. So my break even on this is 144.70. You might ask, well, why would I want to break even at 144.70 when I can just buy the stock at 142? Okay, and that's a really good question. That's a valid question, right? Well, here are the reasons for that. Okay, so number one, owning the stock, you have unlimited risk to the downside, down to zero, right? Stock can't go below zero, unlike when we saw crude futures a few years ago go below zero. A stock can't go below zero. So you do have maximum risk here. If you bought stock at 142 of $14,200. Now on the opposite side of that, okay, if I were to buy that call option, the 140 strike call option that gives me the right to control Apple at 140, if the stock goes down, if I'm wrong and Apple, goes down to 130, 120, 90, whatever it is, I can only lose what I paid for the call option. So my maximum risk by owning that option, which gives me the right to buy stock at 140, is $4.70, or the notional value of $470, no matter what. So that's number one. That's a huge, huge benefit, right? I have unlimited risk down to zero if I own the stock. If I own this option, all I can lose is what I pay for that option. Never a penny more. Now, let's look at the amount of leverage that options give you also. Okay? If you are willing to buy Apple stock, as we showed above here, at 142, and you are willing to invest $14,200. Okay? So if you were willing to buy 100 shares and invest $14,200, well, if you used options, how much stock could you control with the same amount of money? Well, the way we look at that is your investment of $14,200, divided by the amount that each option cost me. Okay, which was $470, right? Each option cost me $470. Okay, so 14,000 divided by 470 is approximately, I don't have my calculator here in front of me, I could do it, is approximately 28 and change. Okay, so equals approximately 28. And we don't care about fractions or decimals because we can't buy half of a contract. Okay, so 14,200 divided by 470 equals roughly 28. That means for the same exact investment, $14,200, buying 100 shares of stock, I could buy 28 of these call options, which allows me to control 2,800 shares of stock at a price of 140. Now again, it's 140 plus what I've paid for that right, which is $4.70. But you can see just right here in its most basic form, the amount of leverage that options give you. So for the exact same investment of buying 100 shares of Apple, I could buy this particular option, which allows me to control 2,800 shares of stock. Okay, the other benefit, as we discussed, if the stock goes down, you have unlimited risk down to zero owning the stock. You can only lose what you paid for your option. Now, there is a little give, right? Whenever there's a big benefit, there's got to be some sort of give on the other side. That give is if the stock goes up. Remember, if you own the stock at 142, you start making money right away. 142.10, 143, 149, you're making money. If you own this option that you paid $4.70 for, you don't start making money until 144.70. But remember, now you're able to make money on 2,800 shares of stock instead of 100 shares of stock. Okay, so in its most simple form, options give you an incredible amount of leverage to have the ability to control more stock without paying more. Or if you want to just do the same 100 shares of stock, $14,200 to buy 100 shares, $470 to buy one option, which gives me control of 100 shares of stock. Okay, so those are call options. And I'm going to put this right here. These are call options. Now, the other sort of option is called a put option. Same principle. You get the same amount of leverage, okay? But put options don't give you the right to buy stock at a certain price. They give you the right to sell stock at a certain price. So let's stick with Apple again. And the stock is trading in the same place right now at 142, okay? And if you look right here, here's 142. The 142 put option now. These were calls on this side, puts on this side. The 142 put option cost me roughly $3. Okay? Cost me $3. Now, what does that allow me to do? Let's go back to the whiteboard because, again, it's the exact same principle, the exact same characteristics as call options, but this allows me to sell stock. So I can sell, if you were bearish in Apple, if you thought the stock was going down, I can sell 100 shares at 142 and collect $14,200. And what's your maximum profit there? Well, your maximum profit would be if the stock goes to zero. Okay, so if stock goes to zero, you can make $14,200. But what if the stock goes up? What if the stock goes to 150, 160, 180, 200, whatever it is? You have unlimited risk to the upside, right? And theoretically, a stock can go to infinity. So you have unlimited risk to the upside. You can sell your stock, collect $14,200. That's going to go into your account right away. But you're going to have a pretty big margin issue because your brokerage firm, your clearing firm, is going to look at that and say, wow, you've got unlimited risk here. They're going to charge you a lot for that position. Or you can use options. You can buy a put option. So again, we talked about calls, which give you the right to buy stock at a certain price up to a certain time in the future. Put options give you the right to sell stock at a certain price up to a certain time in the future. So the December 16th expiration, so same expiration as we just used in the call example, 142 strike put option cost us $3. Okay, so what does that allow us to do? Well, it allows us to control this option up until December 16th, the expiration. And if we want, we can turn our put option into a stock sale at 142, the exercise price. Okay? That cost is $3. So the cost to potentially sell stock at 142 is 3 times 100. Remember, every option price comes with that 100 multiplier because it allows you to control 100 shares of stock, or $300. It will cost me $300 to be able to sell 100 shares of stock. Okay? Now, why would I do that? Why would I do that? Let's look at the pluses and minuses. Okay? My break even here, okay, is selling stock at 142 less the $3 that I paid for the right to do that. So I won't start making money until Apple went down below 139 at expiration. Okay, where if I sell 100 shares at 142, I start making money, it goes to 141.90, 141, 140, et cetera, et cetera. Okay, so that's my opportunity cost here, is that I don't start making money until 139 or lower. Okay, so essentially, if the stock went to zero, I would make $13,900. Okay, if stock goes to zero, you can make $13,900, which that's not as good as if I had just sold stock at 142 and I could make $14,200. Right? So giving up $300, the cost of the option. But what are the benefits? Okay, so number one, I can only lose what I pay for the option, just like with a call option. So let's say we want Apple to go down. That's how we would make money. What if Apple goes up? Okay, what if it goes to 150, 160, 190, whatever it is? Again, you have that unlimited risk if you sold the stock. But if you buy a put option, the only amount you can lose, is what you pay for that option, or a maximum risk in this case of $300. So that's a major benefit. Okay, and when you do that, your brokerage firm, your clearing firm is going to look at that, and you're going to have minimal margin on that because you know what your maximum risk is. Now, just as we went through the leverage that a call option can give you, put option does the same thing. Okay, so if you were willing to short or sell stock at 142, okay, and collect $14,200. Okay, now here you are paying to have the opportunity to sell stock. But let's get to that equivalent 14,200 number. 14,200 divided by our cost per option of 300, okay, is roughly 45-ish. What that means is, for the same exact number, I can now control being short Apple at 142, but 4,500 shares, 45 options. Again, this shows you the amount of leverage. All right, everybody, that is a basic introduction to options, call options, put options, and the massive amount of leverage, the opportunity that trading options allows you. And again, if you're a stock trader, trading options alongside with trading stock can absolutely enhance your potential profitability. So if you're interested in learning more and getting much more in depth than what we just did here, visit us at prospertrading.com, where we have an absolute full library full of videos, training videos to take you step by step along the learning curve. So thanks so much, everybody, for tuning in. Again, remember to like, comment, and subscribe. We'll see you later.